Welcome to House Lux Estate, your number one source for financial insights and market updates. You're in the right place if you're looking for comprehensive, easy-to-understand analysis on the complexities of the financial world. Today, we're tackling a topic that's been the subject of intense discussion among investors, economists, and policymakers alike: the impact of Federal Reserve policies on the stock market. For those who may not know, the Federal Reserve, often referred to as the Fed, is the central banking system of the United States. It's responsible for regulating monetary policy, which includes controlling inflation, managing employment levels, and stabilizing prices to ensure economic growth. One of the Fed's key tools for achieving these objectives is through influencing interest rates. And it's this relationship between the Fed's policies, particularly interest rates, and the stock market that we'll be exploring in depth today. So buckle up for an intriguing journey as we dive deep into the world of finance to understand the impact of Federal Reserve policies on the stock market. The Federal Reserve, often referred to as the Fed, is the central bank of the United States. Established in 1913, it serves as the guardian of the nation's economic health. Its role isn't just about printing money or setting interest rates, it's about steering the economy on a safe and steady course. Imagine the economy as a ship sailing through a sea of financial uncertainty. The Fed is like the captain of this ship, adjusting the sails and steering the wheel to keep the ship on course. It does this through its control of the monetary policy, which is essentially a set of tools used to manage the amount of money circulating in the economy and to keep inflation at a level that promotes economic growth. The Fed can use these tools in several ways. For example, it can change the federal funds rate, which is the interest rate that banks charge each other for short-term loans. By raising or lowering this rate, the Fed can influence the amount of money flowing through the economy. When the Fed increases the federal funds rate, borrowing becomes more expensive, which can slow economic activity. On the other hand, when the Fed lowers the rate, borrowing becomes cheaper, which can stimulate economic activity. Another tool at the Fed's disposal is open market operations. This involves buying or selling government securities to control the amount of money in circulation. If the Fed wants to increase the money supply, it buys government securities. If it wants to decrease the money supply, it sells them. The Fed also has the power to change the reserve requirements for banks. This is the amount of money that banks must hold in reserve against deposits made by their customers. By adjusting this requirement, the Fed can influence how much money banks have available to lend. In essence, the Federal Reserve is the architect of the nation's monetary policy, shaping the financial landscape through its decisions. The Fed's decisions can significantly influence the stock market. But how exactly does this happen? Let's find out. The Fed's policies and its influence on the stock market can seem complex, but we can break it down to simpler terms. Let's start with the two key tools the Federal Reserve uses to manage the economy: the interest rates and the money supply. The interest rate is the cost of borrowing money, and the Fed can raise or lower it. When the Fed lowers the interest rate, it becomes cheaper to borrow money. This encourages businesses to invest, expand, and hire more employees. It also encourages consumers to spend more. All of this increased activity can stimulate economic growth and often leads to an uptick in the stock market. On the flip side, when the Fed raises the interest rate, it becomes more expensive to borrow money. This can slow economic activity as businesses may hold off on expansion and consumers may cut back on spending. This slowdown can lead to a downturn in the stock market. Now let's talk about the money supply. The Fed can increase or decrease the amount of money circulating in the economy. When the Fed increases the money supply, there's more money available to spend and invest, which can stimulate economic growth and boost the stock market. However, if the money supply grows too quickly, it can lead to inflation, which can erode purchasing power and hurt the stock market. Conversely, when the Fed decreases the money supply, there's less money available to spend and invest. This can slow economic growth and possibly lead to a downturn in the stock market. However, if done correctly, it can also help keep inflation in check. So, you can see that the Federal Reserve's policies can create a ripple effect through the economy, influencing everything from business investments to consumer spending to the stock market. So, we see that the Fed's decisions can either stimulate or slow down the economy, and this has a direct impact on the stock market. To better understand this, Let's look at a real-life example. Let's journey back in time to the year 2008, a year that will forever be etched in the annals of financial history. This was the year of the Great Recession, a global economic downturn that saw millions of people lose their jobs and homes. Right at the heart of this crisis was the United States, and playing a pivotal role was the Federal Reserve, the country's central banking system. The stock market, once a vibrant hub of economic activity, was in freefall, with investors panicking and companies folding. The Federal Reserve, recognizing the gravity of the situation, decided to take action. It implemented what is known as quantitative easing, a monetary policy where a central bank purchases longer-term securities from the open market in order to increase the money supply and encourage lending and investment. In simple terms, the Federal Reserve was essentially pumping money into the economy, hoping to stimulate growth and restore confidence. But how did this affect the stock market? Well, by increasing the money supply, the Federal Reserve effectively lowered interest rates. This made borrowing cheaper, which in turn encouraged businesses to invest and expand. Investors, seeing these positive developments, started buying stocks again. Slowly but surely, the stock market began to recover. Companies that had been on the brink of collapse started posting profits again. The Dow Jones Industrial Average, a key stock market index, began a steady climb that would continue for the next decade. But the Federal Reserve's policies were not without their critics. Some argued that by artificially inflating the stock market, the Federal Reserve was creating a bubble that would eventually burst, leading to another financial crisis. Others contended that the policies favored big corporations and the wealthy, while doing little to help ordinary Americans. These criticisms notwithstanding, there's no denying that the Federal Reserve's policies played a crucial role in stabilizing the stock market during one of the most turbulent periods in recent history. The case of the 2008 financial crisis serves as a stark reminder of the power that central banks wield and the profound impact their policies can have on the stock market. So, whether you're an investor looking to make your next big move or simply someone interested in understanding the economic forces that shape our world, it's important to keep an eye on the Federal Reserve and its policies. After all, as we've seen, these policies can mean the difference between a thriving stock market and a crashing one. This case study provides a clear illustration of how the Federal Reserve's policies can influence the stock market. So the next time you hear about the Federal Reserve changing its policies, remember the lessons of 2008. It could be a signal of what's to come in the stock market. So, as we've seen, the Federal Reserve holds a significant role in the performance of the stock market. Its decisions, policies, and actions can have a profound impact on the financial world, influencing everything from the prices of individual stocks to the overall direction of the market. Let's recap the key points. The Federal Reserve, or the Fed as it's commonly known, is the central banking system of the United States. Its primary goal is to maintain the stability of the financial system and to promote sustainable economic growth. It does this by managing monetary policy, which includes controlling interest rates and regulating the supply of money. The Fed's actions can swing the stock market in either direction. When it increases interest rates, borrowing becomes more expensive, which can slow down economic activity and put a damper on stock prices. Conversely, when the Fed lowers interest rates, borrowing becomes cheaper, sparking economic activity and potentially lifting stock prices. In our case study, we delved into a real-world example of how the Fed's policies influenced the stock market. The period we examined demonstrated how the Fed's decision to cut interest rates led to a boom in the stock market. However, it's important to remember that while the Fed's actions can steer the market, they don't control it entirely. Other factors, such as corporate earnings, political events, and global economic conditions, can also play a major role. In the end, understanding the Federal Reserve and its policies is crucial for anyone involved in the stock market. Whether you're an individual investor or a financial professional, keeping an eye on the Fed's actions can provide valuable insights into the potential future direction of the market. Thank you for joining us on House Lux Estate. If you found this video helpful, don't forget to subscribe to our channel for more financial insights. Until next time, stay financially savvy.